Are you going to be subject to IRMAA, an income-related monthly adjustment amount, on your Medicare Part B and Part D premiums? I've got 5 frustrating facts about IRMAA and how you can plan around it. That and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Have you heard of IRMAA? So IRMAA, everything in finance is an acronym, okay? So for Medicare, if your income is above a certain threshold, then you actually have to pay a surcharge. You have to pay a higher amount for your Medicare Part B and Part D premiums. This was added thanks to Congress back in 2003, and we know the challenges financially with Social Security. Well, the challenges are even worse with Medicare. And so this was instituted 20 some years ago as a way to help cover the costs and help make Medicare more financially stable. But it essentially means that if your income, modified adjusted gross income, is above a certain level, then you have to pay a surcharge to your Medicare Part B and Part D premiums. You might be thinking, well, wait a second, isn't there a choice that I get to make with Medicare? What if I don't choose traditional Medicare, which is Part A, B, D, and a supplement? What if I don't do that and I choose Medicare Part C, Medicare Advantage, and that's how I'm going to get around this issue? I won't be subject to IRMAA because I'm going to choose Medicare Part C. Well, guys, Medicare Part C, you pay the Part B premium, so you're subject to the surcharges as well. There's no hiding from this. You've got to plan around it. So, IRMAA, income-related monthly adjustment amount. Here's 5 frustrating facts about IRMAA. Then I'll tell you how to plan around it. First, IRMAA follows the prior year rule. That's right. I said that twice intentionally. Prior year. So I told you that the amount that you pay for your Medicare Part B and Part D is linked to your modified adjusted gross income. Okay, great. So is it based on this year? Well, that would be all too simple. It's actually based on not last year, but the year before that. And why? Because that's often your most recently completed tax return. So if you think about the why, and this one actually Congress, it's logical. So I'm not going to accuse them of that too frequently, but it's the most recent completed tax return that you have, even if you extended the filing date of your tax return. Why? Because so the upcoming year, 2025, what's the most recent completed tax return that you have, that the IRS has or Social Security Administration has on file to base your IRMAA for 2025 on? Yeah, your 2023 tax return. That's the most recent data. So therefore, your 2025, whether you're subject to IRMAA or not, is based on what happened on your taxes back in 2023. Very, very confusing, causes a lot of surprises. That's the first frustrating fact. Second, when you look at these thresholds, that the bands, the income bands, that when your income exceeds these levels or gets into these levels, this is the amount of surcharge monthly that you have to pay. These are the numbers that apply to your 2022 tax return. These are the numbers that apply to your 2022 tax return for IRMAA in this year, 2024. Here's the deal. You didn't have these numbers. These were not available to you back in 2022. So that when you were doing your planning and you had awareness of your income back in 2022, how much should I withdraw from my IRA and what, should I harvest some capital gains? Should I harvest some capital losses? These numbers, these thresholds weren't available to you back in 2022 for planning. Therefore, it's mostly a guess. There's some proactive planning that you can do, but you're unable to be precise because of this prior year rule and not knowing what the bands are. Let me say that differently. Here we are in 2024. That's when I'm recording this video. And we're serving clients that are going to be close to the IRMAAs, these IRMAA thresholds. And we're figuring out, well, should you also do Roth conversions? Should we harvest any capital gains? Should we do qualified charitable distributions? All of these sorts of tax strategies that we're figuring out. And yet we're doing it right now in 2024, and we don't know what the IRMAA, the income-related monthly adjustment amount, income thresholds are going to be in the year 2026 when this actually matters. So because of this, it makes it very difficult to plan. Third frustration with IRMAA is going back to these bands, $1 over. If your income is $1 over, it pushes you into the next band. There's no phase out. If you're familiar with some of the tax rules regarding can you make a Roth IRA contribution or do you get an American Opportunity Tax Credit, something like that, oftentimes those rules have phase outs. And what does that mean? Well, that's essentially just, if your income happens to go up $1 more than this threshold, you're not going to lose all of the benefit. We're not going to take all the goodies away from you. It'll sort of be phased out. Well, with IRMAA, not so. With IRMAA, if you have $1, let's say that you think your income is going to be around, as a married couple, around $205,000. You think it's going to be right there. But because all of a sudden interest rates rose and now you're getting a higher interest rate on the cash you have at the bank or on your CD, that's a great benefit. But now that extra interest pushes your modified adjusted gross income up to just over $206,000. And because of that, now you're subject to the income-related monthly adjustment amount, that surcharge. There's no phase out. There's no sort of blending in or smoothing in. $1 over, whether it's into the first threshold, the second tier, the third tier, what have you, $1 over in income subjects you to that IRMAA threshold. Fourth frustrating thing about IRMAA is if you are married, take all these numbers and multiply them by 2. That's right. Oftentimes when you're looking at IRMAA, and for those that are just kind of, their eyes are open to, wait, what is this? How does this work? You're looking at resources like I just showed you and you're saying, okay, the threshold is $83 a month and yeah, that's frustrating, but okay, well, there's, it's a surprise. Oh, well, no, it's not $83 if you're married. It's $83 for you and $83 for your spouse. So now, again, that's the lowest tier, but you're suddenly, surprisingly subject to IRMAA, and it's not going to cost you $83 a month for the same thing. It's going to cost you over $160 a month because you're a married couple, and it applies to both of you. Even if it's just, that we weren't even aware of this. This was a surprise. Well, it's going to apply to you both. And then the fifth frustrating fact about IRMAA is that one-time events absolutely could apply and could cause you to pay IRMAA even though you weren't even aware of it and you've never had it on your radar screen before and you'll never be subject to it again. Something like, we need to buy a new vehicle. Let's take a chunk of dollars out of our IRA, not knowing that withdrawal from your IRA is going to be taxable income, going to move you into that next threshold, and all of a sudden, 2 years later, right? Not the next month, not when you file your tax return, you'll get this notice. No, 2 years later, at a time when you probably won't even remember drawing the money out, that's going to cause you to be subject to IRMAA. What about selling a house, selling a rental property, receiving an inheritance where some of the dollars are taxable, selling a business? Those one-time events could cause you to be subject to IRMAA, income-related monthly adjustment amounts, even if it's just once in your lifetime. Those are 5 of the frustrating facts about IRMAA, but none more frustrating than that all of a sudden, without you being aware, your income can cause you to pay more for your Medicare Part B and Part D than you otherwise would. And I'm all for paying more and getting more, but in this you pay more and get the exact same thing. So what's the solution? Proactive tax planning. Proactive tax planning. You should be aware, hopefully you are, that tax planning is one of the 6 areas of your financial life, my financial life, everyone's financial life. And tax planning is different than tax preparation. Tax preparation is reactive, just like this. So often, IRMAA is reactive. Wait, I got this notice? Is this real? I've got to pay extra for my Medicare Part B and Part D? It's reactionary. Tax planning is proactive. It's looking ahead, often years in advance, for what's my income threshold, what will my income look like out there, and what will the consequences be? What tax bracket will I be in? Will I be subject to IRMAA? What will my required minimum distribution push me into? And from that visibility, you'll be able to plan ahead. Oh, we should do some Roth conversions. We're buying a vehicle next year. Let's take a little bit out of the IRA this year and stuff it in the savings account so that we don't have to take out too much next year and push us into an IRMAA threshold or where we'd be subject to IRMAA. So proactive tax planning with your certified financial planner, with it being in the context of all other areas of your financial life, that's how you avoid each of these 5 frustrating facts about IRMAA and all of the others. So work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.